Welcome back to the deep dive. Today, we are scrapping in for a really interesting ride.
We really are.
We're looking at a company that just wrapped up what they're calling a fantastic 2025. But we're not just looking at the highlight reel.
No marketing fluff here.
We are doing a deep dive into the Q4 2025 earnings remarks from the CFO of a major fintech player.
That's right. And honestly, fantastic might be an understatement based on the numbers. We're looking at a transcript of their CFO's presentation on Q4 and maybe more importantly, their roadmap for 2026.
Yeah, and the mission for today is pretty specific. We want to understand how a modern digital bank actually makes money, how they balance risk when everyone else is, scared to lend. And this is the part that honestly blew my mind, why they're changing the rules of their own accounting game in 2026.
It's a fascinating case study in fintech maturity. This isn't just an app that moves money around anymore.
Right.
This is a licensed bank acting like a sophisticated marketplace. It's a glimpse into the future of lending. Exactly. And just to do a quick vibe check before we get into the weeds, the tone here is incredibly bullish.
Oh, absolutely.
I mean, they are projecting serious confidence, growth is up, margins are up, and profits are, 4 times what they were a year ago.
It's a strong position to be in. When a CFO starts using words like fantastic and record-breaking, you have to pay attention.
You do.
But as always, the devil's in the details. It's one thing to have a good quarter. It's another to set up a good decade.
So let's unpack this growth engine because the numbers are startling. The headline that jumped out at me was the loan originations.
Yeah.
In Q4 alone, they originated $2.6 billion in loans.
A 40% increase year over year.
That's a lot of money going out the door.
That is massive volume, and you have to look at the context here. This isn't just people clicking apply on a website.
No.
This is the bank approving them, funding them, moving the cash. They're saying their value proposition is just that attractive to borrowers right now.
And that's key, finding the right people. But here's where it gets interesting for me. They aren't just holding all these loans, are they?
No, absolutely not.
They can't be sitting on $2.6 billion of new debt every quarter. That would blow up their balance sheet.
No, and that is the critical marketplace dynamic.
Yeah.
This is the difference between a traditional bank and a modern fintech platform. They move the money.
So they originate the loan.
They find the customer, give them the cash, and then they turn around and sell that debt to investors.
So they're the middleman.
In a sense, yes, but a very sophisticated one. The CFO explicitly said that investor demand for these loans is robust.
Right.
In fact, the prices for these loan notes, the bundles of debt they sell, are actually rising. Investors are paying a premium.
Okay, so investors are hungry for this paper. But there was a detail in the source about loss sharing that I wanted you to clarify.
Ah, yes.
The CFO said they didn't need loss-sharing arrangements to sell these loans. That sounds good, but what does it actually imply? Why is that such a flex?
That is a huge vote of confidence from the market. Usually, if an investor is worried a loan might go bad, they might demand a loss-sharing agreement.
It's like an insurance policy.
It's exactly an insurance policy.
Yeah.
The bank says, okay, buy this loan, but if it goes bad, we'll cover, say, 50% of the loss. It reduces the risk for the buyer.
Right, because the buyer doesn't fully trust the product.
Exactly. It's a sweetener you add when the deal isn't quite good enough on its own.
And here they're saying...
Here, the CFO is saying they sold these loans without that safety net. That implies investors have high confidence in the credit quality. They're buying the debt as is.
That makes perfect sense. It's like selling a used car without a warranty. If people are fighting to buy it, they must trust it.
That's a perfect analogy. And speaking of trusting it, let's talk about this seasoned strategy. This is something that really sets them apart.
I saw that. They held about $1.8 billion in loans specifically to let them age. What's the logic there?
Yeah, seasoning a loan. What does that even mean?
Right, I think of a steak.
Well, this is where having a banking license becomes a strategic weapon. A non-bank fintech usually has to sell a loan the second it's made to get the cash back.
They live hand to mouth.
Exactly. But because this company's a chartered bank, they could afford to hold on to the asset for a while.
But why hold it? Why not just flip it immediately and take the profit?
To prove it works, they hold the loans long enough to show a track record. The borrower makes their first few payments on time, the history looks clean, and then they sell it.
I love that. It's like proofing dough before you bake it, or aging wine.
That's a great analogy. You make it more attractive to the buyer because it's stable. By the time they sell it, the risk of early default has dropped way down. It's a premium product.
And they also mentioned keeping about $500 million of loans entirely for themselves just to earn the interest.
Which leads us right into the money talk. margins, cash, and expenses.
Right. Net interest income, that's the profit from the loans they hold, hit a record $163 million.
Up 14%.
And non-interest income, the fees and gains from selling those loans jumped 38% to $103 million.
Those are healthy jumps. But I want to dig into the net interest margin, or M. It came in at 6%.
Which was way up from last year, but it actually dipped slightly from the previous quarter.
Exactly. Why the dip? If everything's so fantastic, why are our margins compressing even a little bit?
This is a classic case of what the CFO called the cash drag. Essentially, they were hoarding cash.
Hoarding cash, like stuffing it under a mattress.
In a corporate sense, yes. They are preparing for massive growth in 2026. To fund that growth, you need liquidity. You need actual cash on hand.
Okay, so you can't lend what you don't have.
But here's the rub. Cash sitting in a low-yield account doesn't earn much interest.
Right. It's lazy money.
So holding that extra cash drags their average margin down. It dilutes their profitability temporarily.
So if they hadn't been stockpiling.
The CFO is very specific. Their margin would have been 0.17% higher. It would have been flat or up. So the inefficiency isn't a mistake. It's strategic preparation.
It's like a race car pitting for fuel.
Got it. They are loading the cannon. And speaking of that, their operating expenses jumped 19%. Was this just waste?
Not according to the CFO. They were very clear. This is marketing spend. They spent $169 million, and the driver was marketing to fuel the customer acquisition funnel.
So they are spending money to find the people who will borrow the money they're hoarding cash to lend.
Precisely. It's a synchronized dance. You have to acquire the customers before you can originate the loans.
Okay, but that brings us to the health check. You can grow fast, but if the borrowers don't pay you back, you implode.
The ultimate nightmare.
We've seen that story before.
But the source says their credit performance is solid. They claim delinquency rates are lower than competitors.
They do. But looking at the numbers, I saw they set aside, or provision, $47 million for potential losses. If the credit is so good, why are they putting almost $50 million into the rainy day fund? That seems like a lot.
This is a really important nuance, and it sets up the big accounting change we need to discuss. It comes down to what they are lending for.
Okay.
They mentioned a shift toward large purchase loans. Think home improvements, HVAC systems.
Bigger ticket items, not just a new pair of shoes.
Right. And bigger ticket items usually mean longer loan terms. You might pay it off over 3 to 5 years.
Sure.
Under the current accounting rules, if a loan lasts longer, you have to set aside more money up front to cover potential future losses.
So it's a math problem.
That's just how the math works. So a high provision here doesn't necessarily mean they expect bad behavior now. It means the loan duration requires a bigger safety buffer on day one.
That is a critical distinction. It's accounting mechanics, not borrower panic.
Exactly. And the ultimate vote of confidence came from the company itself. They're buying back their own stock.
Yes, $12 million worth in Q4.
Which signals two things. One, they have excess capital. And two, management believes the stock is undervalued. You don't buy your own stock if you think it's about to tank.
Putting your money where your mouth is.
Absolutely.
Okay, so the business is healthy. But now we have to talk about the pivot. This was the most complex part of the source, but maybe the most important, the move to fair value option, or FVO.
This is a big deal. It sounds dry. I know accounting logic usually puts people to sleep, but it fundamentally changes how they present their success to the world.
To understand why, we have to look at the problem with the old way, right? The upfront penalty.
Exactly. Under the current standard, CECL, whenever you originate a loan, you have to estimate all the money you might lose on it forever and record that as an expense immediately.
Let me get this straight. If I lend you $1,000 today, and I think you might not pay back $50 over 3 years, I have to record a $50 loss today.
Correct, even though you haven't missed a payment. This means if you grow really fast, you actually hurt your short-term profits.
It punishes growth. The better you do, the worse your income statement looks in the short term.
It's like getting a penalty for scoring a goal. It's bizarre.
So what's the fix? What is fair value option?
FVO changes the lens. Instead of calculating theoretical future losses, you value the loan based on what the market would pay for it today.
Market price. Like checking the Zillow estimate for a house.
Yes, exactly like that. If you originate a $1,000 loan and the market says, hey, I'd buy that for $1,020 right now, then you mark it at that value. It removes that massive upfront penalty.
That sounds a lot cleaner. The CFO said it improves capital efficiency, but is there a catch?
The catch is volatility. Market prices fluctuate. If the economy tanks, the value of those loans drops, and you have to record that loss immediately.
Okay.
And the immediate impact they warned us about is that Q1 2026 is going to look noisy.
Noisy. CFO code for confusing if you weren't paying attention.
Precisely. They said FEO adjustments will double in Q1 because they're applying this to all new loan volume, and those large purchase loans often trade at a discount initially.
And what about expenses?
That changes too. Marketing costs and fees get recognized instantly rather than being spread out. It rips off the Band-Aid.
So for the listener, the takeaway is when Q1 numbers come out, the headlines might look wild.
Yes. It's not necessarily that the business changed, but the ruler they used to measure it changed. It's going to be messy before it gets clean.
All right, let's look ahead. The 2026 outlook. They laid out some pretty aggressive targets.
Aggressive is the right word. They're forecasting Q1 originations to be up between 28% and 33%.
So around $2.6 billion again, and for the full year.
Up to $12.6 billion in total originations.
That is serious scale. Over $1 billion a month, and earnings per share.
They're guiding for a full-year EPS of $1.65 to $1.80, which is a huge jump from the $1.16 they just finished 2025 with.
That is roughly a 50% increase in earnings per share. That explains the bullish tone.
It does, but there is one little tax detail we should mention. Part of the fantastic 2025 earnings was because their tax rate was unusually low.
Only 16.9%. Why so low?
They had some R&D tax credits and some beneficial state tax law changes, but the CFO is clear. Don't get used to that. For 2026, the tax rate will normalize to about 24%.
So they have to make significantly more money just to beat last year's numbers because the tax man is taking a bigger cut.
Yes. They're swimming upstream against higher taxes and still planning to grow earnings by 50%.
And they think they can do it.
Based on their guidance, they're confident they can. They're assuming a stable economy and betting on what they call their business stamina.
Business stamina. I like that. It sounds less like a startup pitch and more like a legacy pitch.
It connects back to our theme. This is a maturing company. They have the bank license, the capital, the tech, and now they're aligning their accounting to match their reality.
So let's bring this all home. We have a company that just quadrupled its profits, sitting on a pile of cash to fund 30% growth, seeing record demand from investors, and they're confident enough to rewrite their accounting rules to show the true value of their assets.
It really is a story of evolution. You know, people used to ask, is it a tech company or is it a bank? This suggests the answer is finally yes. Both. They are using the bank license, not just to store money, but to manufacture financial products. They originate, they season like that fine wine, and then they sell.
It's a manufacturing plant for debt.
And business is booming. It changes how you look at the whole sector.
It feels less like the Wild West of early fintech and more like, well, banking, but faster.
It does. And this move to fair value option, it raises a really important question for anyone watching this space.
What's that?
If this company is switching to fair value accounting because they believe it better reflects reality, what does that say about their competitors still using the old method?
Ooh.
Are traditional accounting rules actually hiding the true value, or maybe the true risk, of modern fintech lending?
That is a provocative thought. Are
Yeah.
we looking at the world through the wrong lens, and this company is the first one to put on the right pair of glasses?
It's possible. If FVO becomes the standard, we might look back and realize the old way was obscuring the view the whole time.
Well, on that note, we are going to wrap up this deep dive. A fascinating look under the hood of a fintech giant. Thanks for learning with us today.
Thanks for listening.
See you on the next deep dive.